about day 2, and today we have a lot on the program, so we'll start on time so we can finish on time as well. Karibuni sana. If you have people on the way, please let them know that we are just starting our program to join, and today we have even more fire activities. So to start up our morning, we have mwenyeji wetu kutoka Startup Association who will do her opening remarks, kutukaribisha, and kind of build the foundation of what we are doing today here, what to expect today. And this is no other than a good friend of mine, but also an amazing, talented ecosystem manager of the Startup Association and the co-moderator of this Startup Week. Let's put our hands together for Maureen as she joins up on stage. Karibu sana. Kuna makofi ya kichwa, makofi tafadhali. 1 star, 2 stars, 3 stars, 4 stars, 5 stars, 6 stars, 7. Asante.
Good morning, everyone. So this morning, I'm taking the stage not as a co-moderator, but as a representative for Tanzania Startup Week. Thank you so much for being here again today, and welcome back. So yesterday, we had laid a successful architectural plan for DIRA 2050. We focused on critical skills, pillars such as policy, human capital, and talent pipeline, and the legislative framework needed to thrive. Today, we move from that to budget. Day 2 is mostly dedicated for investment, deal flow, and venture acceleration. A vision as ambitious as $1 trillion economy cannot be fueled with good intention alone. It demands sophisticated, passions, and available capital. So today we are going to have several plenary sessions which will demystify the journey from pre-seeding to successful exiting, exploring not just vision or traditional venture capital, but also alternate model essential for frontier markets. Critically, we will scrutinize the legal framework required to give investors confidence, ensuring that Tanzania is not just competitive, but preferred destination for private equity and genderless investing across the continent. Let today be the day we mobilize capital necessary to propel our startups from local champions into regional powerhouses, making the promise of DIRA 2050 an irreversible economic reality. Let's talk deals, acceleration, and strategic flow of capital. And as we highlighted yesterday, today we are going to have a session around genderless investing, which is going to be hosted by our partner, Grakamako Trust, but we also have corporate and legal governance by Breakthrough Attorney and other sessions. So thank you so much. Karibuni sana sana sana, and engage. Asanteni.
Wonderful. 1 star for her, 2 stars, 3 stars, 4 stars, 5 stars. Kuna namna mnazidi kushuka, mbona mnaangusha maembe. 1 star, 2 stars, 3 stars, 4 stars, 5 stars. That's almost like it. So we're going to start our next session that is going to focus on examining the evolving landscape of startup financing in Tanzania from pre-seed series to A stages. And I would like to take this opportunity to bring up on stage an award-winning CEO, an investment banker, a public speaker, Arthur Mwandishi, investor who was also appointed by the President of the Republic of Tanzania as former chairman of Cereals and other produce board in Tanzania. This is no other than Salum Awad. Let's put our hands together as he comes up on stage to moderate this coming session. Makofi kwake tafadhali until he gets up on stage. And he'll also call his panelists. Karibu sana.
Asante, good morning. I think before the panel, I was to start with a few slides. Yeah? Okay, cool. But I can't see my panelists. Where are they? Ta? Are you one of the panelists? Okay, good. So let's start. So the idea of this session, maybe 15, 20 minutes, is just to give us the context of what's happening at the continent level. Excuse me, in terms of venture capital investing. As we know, as companies start, they need to grow. unfortunately, majority of these companies die. And there's so many reasons why some of these companies die. And one of them could be running out of money or failing to raise money. So we need to know what is happening at a continental level, what is happening in Tanzania. And in our panel discussion, which I'll have with each one of the panelists, to explore what do we need to do as a country to, one, attract more investments to Tanzania, but secondly, what can we do to mobilize local capital, which for me is the most important. So I was asked to just look at the trends, what is happening. So venture capital has been coming to Africa for a while now, but there are a lot of trends that you need to take into consideration, whether you're a startup founder looking forward to raise money at some point. If you're a policymaker, you need to build the right environment for capital to thrive. If you are a development partner, what sort of support you need to give to the market. If you're an ecosystem player, an incubator, accelerator, if you're an academia, a researcher, this is how you build up an ecosystem. Each one has different roles to play. So let's look at the flow of capital and some of the things which are changing over time. I don't know how many of you have been tracking venture capital flow. Thank you. In Africa, at least for the past 7-8 years, you'd see patterns, you'd see trends. Some things are not changing, some are changing. So it's important to look at all those, and maybe 1 or 2 slides look at potentially what might happen in the future. What are we projecting to happen in the venture capital industry? We know a lot is happening globally, but what can happen in Africa, and in Tanzania in particular. So to introduce myself, I'm an entrepreneur, finance professional. I've been working in the finance industry for 16 years, but over time, of course, as a company, we've been diversifying and moving into other businesses. So I run SSC Group, which is a Tanzanian group of companies. So we're in different spaces, apart from finance and investments, which remain to be one of our core businesses. We have also moved into other industries, like real estate, construction, logistics, food, agri, and the likes. But recently, of course, we have been working as a firm for a while now to support initiatives to unlock access to finance in Tanzania. So we have 4 platforms that we operate. One is the Agro Fund, the VC Agro Fund, $10 million fund, which we recently launched. And then we have an angel fund. 2018, we started the first Tanzania Angel Investors Network, which didn't do very well. So we've decided to change the model. So it's going to work as a fund, not as a network, where people can join in and we can allocate some of the money that they have. You have Tanzanians working in the corporate space. They lose money every day. They buy farms, they go into matikiti maji farms and all that, yeah? But they lose money. So what do people do now? They end up investing in traditional financial markets. They buy bonds. Each bond, as you see, BOT is announcing is oversubscribed, whether it's corporate or treasury bonds. People invest in stock markets. People invest in UTT. Do you know how much money has been invested in UTT? 3.2 trillion. It's a lot of money in UTT. But we believe we can diversify some of these funds and reallocate at least 5-10% of that money to startups, if you can put the right things in place. Yeah, there's a lot of money in SACCOs, 1.1 trillion total assets in SACCOs Tanzania. So I think we can tap on some of this money and see how can we reallocate to startups. Okay, wow. Is it me or this thing? So before you talk of course, I was asked to talk about continental flow of capital. but I thought maybe I can just put one slide up at global level so we can measure ourselves where we are as we're building up economies in Africa. So you'd see venture capital investing in Africa so far in 2025 is about $313 billion. This is how much money venture capitalists have invested in startups globally. But you see the size of the circles indicate how much money went into that continent. So in North America, you see the largest, which is $182 billion. And then, of course, next you have Asia, which is about $65 billion next to North America. As we all know, there's a lot going on in Asia. AI, EV, and all that kind of stuff. Then, of course, Europe, followed by Latin America and Africa, trying to play catch up, 2.6 billion. Of course, some reports say 2.2 billion. It depends on which report you read. But one thing we should also know that as much as we're trying to build more startups, startup economy in general in Tanzania, and trying to attract more venture capital money, it's still a small industry. And still many startups are struggling to raise money. So if you look at the data again, less than 1% of startups managed to raise money from venture capitalists this year so far. So if you're not raising money, you shouldn't feel like you're awkward. They cannot raise money from a VC. It's tough raising money from, as we shall see. An average investment per startup globally is about 2.2 million. So that's a typical venture capital investment into a startup at a global level. So one of the things, of course, you'd see 45% of all these venture capital investments globally went into software and AI. This might not be the case in Africa. In Africa, almost the same number of investments by venture capitalists went into fintech. So fintech is still the largest recipient of venture capital money, as we shall see shortly. But one thing we should know is 70% of startups fail within the first 5 years. This is a common statistic which has been around for a while. And people fail for many reasons, as I said, and this is not the discussion for that. And one of the things that investors, of course, when venture capitalists invest in a startup, one of the things they expect is to return their money, plus some sort of return over a certain period of time. So they have to do what we call exit. So what happened is only 1.5% of exits which were done last year were exit at least of $50 million. And when these venture capitalists invest in your startup, there's some sort of return that they expect. So the multiple of what we call invested capital is at least 3 times the money. So if they give you $1 million, they expect $3 million when they exit, plus IRR returns on top of that. And guess what? As much as it's a hassle to raise money, startups are being formed almost every day. Why? Because there are a lot of problems. Startups need to come up with solutions, innovation to address these problems. So globally, per year, 30 to 50 million startups are formed every year. 30 to 50 million, which is almost equivalent to 137,000 startups formed every day. So you can imagine, out of 137 startups every day which are formed, or out of 30 million startups which are formed a year, less than 1% of these will get money from a VC. So you need to be exceptional to raise money from a VC. That's why today we're going to talk about other sources of financing. Yeah? You need to talk about other forms of financing, which I always tell people. Whether you're a policymaker, whether you're a youth activist, you don't want to hold a traditional commercial bank to account why they're not investing in startups, because that's not their space. The same thing applies to VC. So VC will not necessarily invest in everything. So if you want to build a startup economy in any country, you need to have multiple sources of capital that would address different needs, different stages, different sectors, and different requirements of our businesses. Kuna mtu anapeleka au mimi ndo napeleka? I don't know how I got here. How am I using this? Where? Oh, okay. Oh, I'm supposed to put, oh, okay. Wow. Uh, uh-huh. Thank you. Your magic's not working. I just want to go to a previous slide. Okay. So I want to just put this slide to show how much capital is coming to Africa, because the discussion today is about capital flow to Africa, and then we pin it down to Tanzania. So you have seen how much moves across the world, different continents, and what is happening at the African level. So it's less than 1% actually of venture capital money coming to Africa. There's a lot to say here, if you had time. You know, despite the fact that, of course, we talk about the potential that Africa has, population, youth population, of course. 18% of the global population is in Africa, 5% of the global GDP. So you'd expect that more investment will come to tap into such potential of growth that we say Africa has. But unfortunately, less and less capital comes in. There's a lot of factors. Of course, one of the reasons, I think some of you who have been following up about venture capital is, report I think the year before last said 73 to 74% of founders who raised money from venture capitalists were educated outside Africa. So there's a bias in terms of who starts a company and who gets the money. That's why you need to set up your own funds. Yeah? You don't have your local funds, there's nothing you can do, trust me. You must have your local funds that understand the local environment, that understand you, that know who you are, the environment you come in, that understand the risk as you see, not the risk as they perceive on the media. You need someone to understand all these things to bring money here. Another important observation that we had for last year, actually, if you look at the trend between 2021 2024, number of investors who have been coming to Africa, not necessarily coming, but investing, active investors has been going down. You can see from 2021, the first column on the left, to 2024. So out of 520 investors plus VCs who were investing in Africa last year, only 390 of those invested at least $100,000. And then, of course, as you go up higher, only 110 around there made between 2 to 4 deals. And interesting, only 15 out of 520 did 5 to 9 deals. And it's only 8 venture capitalists out of 520 did 10 plus deals. What it tells you is you have so many investors, but not all these investors are investing massively. So this is another thing that we also need to understand when we talk about what sort of funds you are building up, because I think that will be one of the discussions today. So last year has been not the best. If you look at the statistics, the yellow graphs you see, the bar, represent the year. So 2019, Africa, all startups in Africa raised about $1.4 billion. And 2020 was about 1.1, slightly lower. You know what happened at the time, COVID and everything. 2021, we did well, $4.4 billion. 2022, this was the best year, at least for the past 5 years. African startups raised about $4.6 billion from VCs, venture capitalists. And then last year was about 2.2, as I said earlier. Some say 2.6, some say 2.7. It depends, because these reports cover different things. Some reports only report on venture capital deals. Some report total startup funding, which would include grants and other sources of financing. But this year might be a better year, because so far we have done more than $3 billion. So this is how money moves. which you need to understand. So when you're starting up as a founder, you didn't know how much money is available in the market for you to work hard to attract this money. Could be you, could be maybe 5 of you, could be 10 of you in this room. So we wish each one of you who's starting a business and raising money should get the money. Unfortunately, that's not the way capitalism works. So you have to find a way to attract the money. So we need to make sure that the incubators, accelerators do the job to build what we call investable startups, investor-ready startups that can raise more money. And then, of course, interestingly, despite all this amount of money that comes to Africa, there's the amount of money that also comes to East Africa. And this shows Kenya last year was the leader. Kenya attracted most of the venture capital investments in Africa. I know some of my friends don't like me when I compare Tanzania to Kenya, but you have to. You have to. It's your naturally economic rival. It's almost like US and China, no? It's almost there. So we are next with the second largest economy in East Africa. So we track what's Kenya doing. What are we not doing? What are they doing? So you'd see what they did last year. $638 million. Of course, there are a lot of factors behind that. And Tanzania did $53 million, which was less than 10% of what Kenya did. So we need to find reasons why we cannot do this. But again, you can also look at amount of capital that has been coming to East Africa, at least for the past 5 years, between 2019 and 2024. So one thing you'd see is East Africa in particular, last year, received 1/3 of all venture capital money that came to Africa. And guess what? For a period of 5 years, amount of venture capital investments that went to Kenya was $3.3 billion. And the amount of venture capital money that came to Tanzania for 5 years was less than 300 million, which is less than 10% for 5 years of money that went to Kenya. So if you don't like me to compare, then probably there's nothing I can do for you. But you have to. You have to. Someone next to you, your neighbor, you're the second largest economy. You should expect numbers should be not far from where they are. But the difference is huge, insanely huge. We have to find ways to discuss these things. Is it policy? Is it the ecosystem? Is it the startups? All these things we need to discuss and agree and come up with a way forward. So in terms of sectors, fintech, as I said earlier, remains to be the most attractive sectors to venture capitalists, receiving the majority of venture capital money for a long time. And this has not been changing. So last year, as I said, almost 47% of all investments went to fintech startups. So fintech is a financial service company that uses technology as a leverage to offer financial services, whether to reduce cost, to increase inclusion, to increase efficiency, and all sorts of things. Could be in insurance, which is called insurtech. Could be in banking. Could be in microfinance. And this is where I think most opportunities are. Of course, there are a lot of reasons why fintech has remained to be the most attractive sector to most of these investors. But it's changing. The landscape is changing because other sectors are now coming to the shore, like energy. So climate, energy, renewable energy in particular. We know what is happening with climate change. Landscape is changing. Capital now moves to different directions, almost 20%. But that 20% should not fool you. It's very few companies because energy companies tend to raise big amounts because they're asset-heavy businesses. So it might be 20%, there will be 4 or 5 different companies. And then we have logistics and transport, which for me, I would say we have been sleeping on this industry. Huge potential, especially for Tanzania, 13%. And then, of course, you have the likes of healthcare, agri and food services, education, retail, and all that. And education has been one of the sectors in the venture capital world that has been receiving less and less venture capital money for a long time, despite the importance of the education industry. Yeah. I already talked about this. So let's pay attention here. This is another thing which is disturbing in terms of raising money. So what happens is if you're building up a company, if you're a startup founder and you start today, and you make a decision now, I'm going to raise money, let's say from venture capitalists or angel investors or any type of financier that will give you the money. One thing you should know that most of them, it becomes like an addiction that you only raise money once. You keep on raising money, subsequently, what we call rounds. So you start, initially you don't have revenue, you probably have your prototype, you don't have much, we call pre-seed. And then you have your minimum viable product, MVP, you move to the market. Now you have something to show, something to sell. You have some sort of revenue, but not much. You're still packing your business model. Then you're at a seed stage. Then you move further to a product market fit. Then the market understands what you're doing. Then you can sell. Then you go to what we call pre-series A. Then now you can scale. You can hire more people. You can improve your technology. You can invest more in marketing and sales. You can hire more professionals. And then you go to Series A, which is the most common stage of VC money. Then, of course, beyond that, now you want to expand. You want to go other markets. You want to start another line of revenue. So you start diversifying your revenue sources within the company. Then you go to Series B, Series C, Series D, Series E+. And each round, each stage as you grow, you need money. One, you need different types of money. Two, you need different amount of money. And three, the way you approach to raise money is different. So unfortunately, if you look at the startups, 582 startups, according to the data, that raised money between 2019 and 2022, only 26% of these startups managed to raise money in another round. What does it mean? It means 70% of startups that raised money in the first round didn't make it to the second round to raise money. So if you're at a seed stage or pre-seed stage, this is what happens. If you're at a pre-seed stage, one thing you do is pretty much you bootstrap, you use your own money, and whatever capital that you have, and a bit of grant here and there that you have managed to raise, but you don't have much of revenue, so you don't have cash flow to support your company's growth. So what happens is you really depend on external money for you to move to the next stage. So you enter into what we call a valley of death. At that stage, if you don't generate revenue, and if you don't raise money, for 12 months you die. And that's where 90% of startups die, actually. So, and that's where we need more funds, if you ask me. That's where you need more funds. So you don't need funds here to give people $1 million. You need funds to give small tickets of startups which are still struggling at that stage, because that's the most difficult path of building a company. Otherwise, you'll be financing the same people. 16% of those who raised subsequent round went into Series A, and only less than 1% managed to go to Series C. You'd excuse me, I won't have time to explain more into some of these, so I'm supposed just to give the context. And only 3% of these investments managed to go into exit. So it's not easy. This is the message I'm sending. That's why we need to have these type of dialogues practically. Not theoretically, not politically. You need to come up with things that we can really do on the ground. You need to know what is not happening. Tanzania has 70 plus hubs. What is not happening for these hubs to give us enough startups that are investable? Are these hubs startups themselves, which I usually say? Maybe we need to provide a lot of support then before we talk about investment. Is it the policy? Is it the tax regime? What is not happening? These are things we need to discuss. Unfortunately, I don't see a majority of the familiar faces from the government. But these are things you need to put into consideration when you're designing a fund. For Tanzania, when you're building up a policy. For Tanzania, you don't just build a policy for VC, that you took from France, it won't work. Probably we're going to discuss more in the panel discussion. Okay? Another thing which is important is, maybe a few slides before I finish, we start our panel discussion. The difficulty is not just in raising the money between rounds. The difficulty is also how much time it takes for you to raise money between rounds. So in 2021, 2022, it was much easier. It would take less time for people to invest money, to raise money from one stage to the other. But from 2023 to date, it has become more challenging. So if someone is at the launch stage, up to pre-seed, it will take you 16 months to raise money. 2021, 2022. Now it takes you 24 months, double the time. It will take you 11 months to move from pre-seed to seed. Now it takes you 23 months, double the time. It will take you what, 15 months between seed to Series A? Now 28 months, almost double the time. The same, of course, applies from Series A to Series B. It would usually take you 22 months. Now it takes you almost 40 months. That's the time it will take you to raise money. That's why some startup founders decide not to raise money from traditional VCs. So we have Taha, who's one of the panelists today, who will tell us how he chose not to use a VC path to start and grow his business. Or maybe he has now. He'll give us the update. But it's interesting. Currently, you know Currently, yeah? One of the, it's a Nigerian startup founder in the US. Currently, an app that you use to schedule your calendar and other things and all that. It didn't raise VC money until it became a unicorn. It became $1 billion company without VC money. These are the case studies we need to know. What do we need to do to get to that level? Yeah? Because it's not easy raising money. And it's not even easier to raise external money. I always tell people, and no offense, if you have a VC who is based in London, raise money in Switzerland, and set up a company in Mauritius, would hardly do a deal in Simiyu. Do you understand what I'm saying? He wouldn't understand the environment in Simiyu. They'll come in there, they'll stay for 3 days at Hyatt, they'll meet few startups, they'll move to few hubs, and then they get on a plane. There's no way we can attract more money in a market with such type of investment. Someone has to have what we call foot soldiers. You have to put your feet on the ground. So the only thing you can do that is you don't have to force people to do that, because each one start their fund for their own motives, for their own mission. Then you need to have your local funds. You can't avoid it. If you want to grow startups in Tanzania, if you want to unlock more money, you have to have more and more local funds, not government funds. Funds which are professionally structured and professionally managed by professional fund managers. Short of that, you can have more and more funds, and I wish you all the best. National Economic Empowerment Council, what does it have? More than 60 funds. How many funds do you know? Local government, 10% of their collection needs to go to what? Youth, women, people with disability. Cindy, how much was local government collection last financial year? Do you know? 1 trillion? What 10% of that is what? 100 billion, yeah? How many startups raise money from this 100 billion? Because these funds are not structured to support what the market wants. You have to break these structures, get the money, and give to people who can manage the money. But it's changing, of course. Investors' sentiments are also changing. Energy is becoming one of the interesting industries. If you look at 2024, 20% of VC money in Africa went to energy startups. This year, up to October, 33%. Debt is also becoming one of the common instruments in venture capital investment. So usually, a venture capitalist will invest in what we call equity instruments. So they give you the money, they'll take shares in your company, let's say 15%, 20%. They stay in 6.5 years, and then they'll exit if they manage to do that. But of course, debt is now becoming another option for venture capitalists to use as an instrument to finance startups. And of all the venture debt that came to startups in Tanzania last year, to Africa last year, 63 went into energy, because energy tends to have big tickets and asset heavy. And then, of course, we see venture capitalists now also investing in asset heavy business, which it never used to be the case. Venture capitalists in the past tend to invest in asset light businesses, the likes of fintech, because it's easy to scale. But now they're also investing in asset heavy businesses. As you see, debt, almost 42% of all investments last year, and 53% equity. And of course, the other percentages is small sources like grants and everything. So people tend to ask me in many discussions that we have, so what would be an ideal capital for someone who was at the seed stage or at the Series A? So this data, of course, by Africa, the big deal data, analyzed the average transaction size or amount per each stage. So deals pre-seed is about $700,000. That would be an average investment for a startup at a pre-seed raising money. Up to 20 million for someone who's raising at Series B. Series B, you're out there, expanding markets, as I said earlier, maybe moving geographically, investing in more modern technology, hiring CFOs that you could not do at a pre-seed, and the likes. So those are the average amounts that we would see. But one thing which I didn't want to miss as I'm winding up is how much money goes to women. It's so disturbing, unfortunately. Actually, last year, amount of money that female founder startups that raised last year was 4 times less that female founders raised in the previous year. So if the graph is growing, it's going down. So in total value terms, female founders in Africa last year took home only 2% of all the venture capital money. Is it not disturbing? But guess what? McKinsey, I think we all know McKinsey is one of the largest consulting firms. They did the report, which said a company that has more women in the board has 56 more % to be profitable than which has less. 51% or plus of SMEs in Tanzania are female owned. Do you know that? And Tanzania has more than 4 million small businesses. So there are a lot of female founders, and yet they receive less than 3% of all the money comes here. So I don't know, you need affirmative action, I don't know. But these are the things we need to talk about. And these are the things that need solutions. Because young girls go to universities, they graduate, some don't, but they're innovative, they're entrepreneurial, they want to build stuff, but they can't get the money. It's a big challenge. So you need female focus funds, I don't know. You need affirmative action, I don't know. So you'd see the numbers, 2% female CEO, 90% male CEO. 93.5% male only. 5.5% is a mix. 1% female only. I don't want to spend much time here, but the idea here was to see that investors who want to do more bigger ticket sizes than small ones. So you'd see a spike, in the last chart of 10 million. Then let me finish some of the emerging trends. So what is happening now? Because with all these challenges, of course, they are good stories. They are good stories. So don't paint it just a gloomy picture that this is all about VC. No. As we see, $2.2, $2.6 billion. It's a lot of money. that coming down to support startups in Africa. Africa now has 10 plus unicorns, companies which have valuations of more than $1 billion. So, of course, good stories are happening. Some are acquired, some have been acquired by global companies. I don't know if I think we have heard Stephen Masiriwa going into partnership with NVIDIA, building 4 AI factories in Africa. So a lot of things are happening in Africa. But when it comes to venture capital, one of the things which is important is for fund managers, people such as ourselves who are trying to set up funds, to be able to raise money locally. Because it's tough. It's tough for a fund manager to raise money at the global stage, the same almost as a startup founder trying to raise money. Almost painted almost with the same brush. But it's changing now. Venture Platform, which is a Nigerian private equity firm, managed to raise $64 million. And part of the money came from the government. From the government. IDC is a government agency in Nigeria. It's a program to support creative and technology industries. So they managed to put in the money into this fund. Secondly, Ghana has just passed a policy that would require pension funds to allocate at least 5% of their assets to venture capital and private equity. It's a long time coming. Because African pension funds have more than $4 trillion in assets. But it's very tough to get this money. I've had discussions with some of the director generals of the pension funds. I worked in pension fund myself in my employment days. And I'd see bad investments way worse than startups, if they think startups are risky. But we don't do that. Unfortunately, it's also somewhere in the regulations it does not stipulate enough for that, but Ghana has done that. Another thing which is important to note is, in the past, VCs tend only to invest in tech startups. But that is changing now. So SMEs are now making now in the pipeline of businesses that VCs also want to invest. Because SMEs were regarded as non-scalable, traditional, family-owned, that kind of stuff. But it's changing now, which is a good trend. Of course, we also see now some of my colleagues are setting up VC funds now, which have lifespan of more than 10 years. Because traditionally, when you start a venture capital fund, what happens is you go to what we call institutional investors, like pension funds. They give you the money, and that's the money the venture capitalist will invest in a startup. And traditionally, the span of these funds is usually 10 years. But it's very tough to raise a fund, to invest, to exit in 10 years' time. But guess what? We have been doing that because more of the things that we're doing in the startup world and VC world, we have copied from the likes of Silicon Valley, and we are trying to replicate almost the same here. So the 10-year VC fund period is tough because you have to spend 5 years to invest, 5 years to exit. But it takes an average of 6.5 years to exit a company in East Africa, according to Africa. So it's not easy to build a fund of 10 years. So this is changing now. Some are raising a fund which is above 10 years. And of course, we now see corporates coming to the show, trying to see if they can also invest in startups. So what has been happening is I've had these discussions with a lot of corporates. Of course, we're in discussion at a firm level with 3 corporates. The idea was to ask the likes, let's say, if I'm allowed to mention, let's talk about CRDB, a bank which has 15 trillion in assets. Yeah, so you know what? With profits, 400 billion plus, just take 5% of that money and start what we call corporate venture capital fund, CVC. Don't ask me to go to a Vodacom Foundation or CRDB Foundation. They won't cut it. You have to set up a proper VC structure as an arm or a subsidiary of a bank. So if a startup, you go to a bank, they tell you, no, as a startup, you cannot qualify. You don't have collateral, you don't have 3-year period track record, but we have a VC fund. You can apply for that. Do you understand what I'm saying? So that's how the corporate world can really support. Not these running, competitions and then, prize money, $5,000. The demand is insanely huge in the market. We need properly structured schemes that can support startups. And we have the knowledge to do that if people allow us to do that. Another thing which is happening as I'm finishing is startups tend to grow merely organically, getting the money from VCs, and grow. But this is changing now. We see a lot of mergers and acquisitions within startups. We saw Asoko merging with another e-commerce in Egypt to form one company. There'll be a lot of consolidation in the fintech space, fintechs buying other fintechs as well. So this is happening now, startups buying other startups. Shutdowns is becoming common now. Why did I want to mention this? If you go to US and Europe today, it's normal for someone to start and fail and start again. It's entrepreneurially correct. That's why, what is the culture of Facebook? Fail fast, yeah? So you start, you fail, you start, you grow. But in Africa, if you start a business and fail, if there's a family meeting you don't want to attend, because people ask you about the business. It's like a curse. So that is changing now. So we see a lot of startups failing and the founders starting again and again and again. Yeah, so this is pretty much what I wanted to say. Asanteni sana. So let's go to the panel. Yeah? So what I was advised is we're going to have 3 panelists, and we're going to do each at a time. So, and then I'm going to get someone, I think, from CMSA. So we're going to talk about the policy and the legal framework and what is happening now.
It's Tuesday.
Oh, sorry. And then we're going to have a VC, an investor, who will also share insights, what is happening and what can we learn as a country. So just a minute. So the first panelist on the stage, please welcome Taha Juaji, CEO of BIM Africa. Put your hands together for Taha. Yeah, so you can grab your mic. So before we start, I don't want to introduce you of what you deserve, so I'll ask you to introduce yourself. Please.
Thanks. Thanks for the introduction. So my name is Taha. I'm founder of Beam. We're a Pan-African customer communication platform. We've been around for now 15 years, so I've lost track at some point. But we've been in I call it the startup game or the startup race for some time. And we've seen the evolution of the ecosystem because when we started, I think it was very nascent ecosystem. So we've seen the evolution grow. We build software and systems for businesses to communicate with their customers on different mobile channels, SMS, USSD, airtime, and chat. And we do this across 25 different markets in Africa. I don't know if that summarizes that.
Yeah, good stuff. 25 markets. That's a lot of work. And congratulations to you and your team. So what I heard is you have done all that without venture capital money. Is it correct?
That's correct, yeah.
So maybe you can share some experience with the audience here. Why did you decide not to seek? Because you've been there since day one. Yeah, you have seen the narrative of venture capital and some startups trying to raise, but you didn't decide to use that path. Why not? Why not venture capital?
Yeah, it's a good question. We did try raise actually. So when we first started, I think I remember going to competitions. I think at that time, for the folks that might remember, there was a Pivot East in Nairobi and things like that. So we went to many of these competitions. We spoke to many VCs the few that were there, like very, very few. It was basically you couldn't find, you could had maybe like a handful of 5 people that were there looking to invest at that time. And we weren't successful. Like every VC would give us a different reason at that time. Either you don't have the strong team, or your product is too not good enough, or the market is too small, or whatever, right? And so we just decided, look, we're going to do it regardless. And so we just said we went about building and getting customers. So that was that. And then we had a second attempt. It was much later, around 2020. This is after COVID, so 2022, 2023. We looked at raising again. This time, so we were already profitable and growing. And the idea was to accelerate that growth. And we had quite a few discussions. We got a couple of term sheets. One specific one. One was a more advanced conversation. But I did some due diligence on that VC, and then didn't hear good feedback, so we backed out from that. But the main thing that came out of that was all of the discussions. I was spending more time explaining our business to the VCs, right? And I mean, the reason we were looking for money was, yes, the money was part of it, but it was because we wanted to expand and we needed their help to expand, right? And if they didn't understand our markets and our business model and how we work, it wasn't really going to be helpful, right? So we, part of the reason we said, okay, this doesn't make sense, is because we didn't think they were going to add value to our business. Yeah, so that's kind of our track record with.
So usually we also have this practice that before you take money from the investors, of course, investors tend to do due diligence on founders. But you, of course, you went further. You also did due diligence on investors. And also always tell people to do that, because you need to know if there's a fit and if they're genuine, if they're the right people for you to bring on board. So how did you do that? And did you tell the investor that you're doing a DD for them?
No, I didn't. So I used whatever networks I had to find out what I could. Funny. It was really interesting people. I went to UAE to meet them, to Abu Dhabi specifically. And these guys they're like, okay, let's meet at this hotel. It's the St. Regis in Abu Dhabi. It's like probably one of the most expensive hotels there. And I was like, okay, we'll meet there. I thought they were just there for some reason and we're meeting. But I find out that they're living in the hotel. Like they stay in the hotel, and then they're like, oh, we're permanently here and we're just meeting people from here. So, I mean, this is just one thing, but it was just like a red flag, like this doesn't make sense to me. But there were other things I learned as well. So, but yeah, I did due diligence just through, by talking through my networks. Yeah.
So when you started, as you said, it was just a handful of VCs actually at the time coming to invest in Africa. And the environment was pretty much tougher than now. But the landscape has changed now. We have 500 plus VCs that invest in Africa. You have the likes of Afri Capital that help companies to raise money. So you have more, because in the West, we all know, companies don't raise money. It's the intermediaries, it's investment banks and advisors who will do that. If we were to do it again, would you go for VC, given the current environment now?
I think we definitely have a more improved environment. I think the market is better in terms of availability of funds back then, compared to back then. I think Tanzania is still not there yet. I think if you go to Nairobi or go to Kenya, they definitely a much better. I'd say there's more money than deals. At least that's what I found out in 2022, 2023. there was a lot of money there. They just didn't have people who fit the right bucket and their check boxes of, so there's definitely money there if you can make it fit and you're the right model, the right sector, all of those things, right? I would still not raise money early on. I would raise later.
Okay.
Because I think our markets take longer to find product market fit, right? And it's better to do product market fit before you raise external money. Raise from friends and family and grants, or grants is a bad example, but it helps with the product market fit phase because it'll be less stressful, right? Like then once you've figured out product market fit, then use the VC money to accelerate. And it's fine, it can take longer, right? Because the VCs will, and that's the other thing that we learned, is that the VCs are only worried about your next raise, because it's either they can exit or do a follow-on, etc. Right? So you may not necessarily fit that cycle of 18 months or 2 years or 3 years to raise again, because you're still haven't found product market fit. So I think that's a distinction that I would make, that we're not ready yet in terms of, if we look at SaaS, let's say B2B SaaS, it's not there yet, right? So I would make that clarification.
Okay.
But yes, I think the money is there. Tanzania alone is too small a market for any business, any tech startup. Tanzania alone is too small, right?
Yeah.
So either you need to be looking at 3, 4, 5 African markets or the entire region. And so you will need to grow beyond Tanzania. And I would urge people to start thinking about that from day 5, like as soon as you have your basic product, like start thinking about, okay, is there a market for this beyond Tanzania? Because otherwise it's too small, right? It's too small.
So I was listening to this interview. This guy, Nigerian, he started a bank, one of the the 3 largest banks in Nigeria. And he was talking about how he started this bank. And one thing he said was he had $5 million and then he started a bank. And the question is, how did you get the $5 million in the first place? So maybe I want to ask you the same thing. How did you finance your business when you started? As you grow, probably you can reinvest your cash flows and everything. But initially, take into consideration, most of the families are not wealthy in Africa. So relying on family and friends might not be an ideal way to do that. So what other options do you think startups maybe in the room, they will need to consider if they are to go to raise money for the first time now?
You're talking in general, right?
In general, yeah.
I think, so there are some angel investor groups now, right, which is a very, very positive sign. I've done some angel investments myself. So this is a very positive sign, right? And the ecosystem has to reinvest, even if it's small, right? So that's a very good sign. I think there is disposable income. People are investing in real estate, watu wananunua viwanja, right? So that money is there. It's just that how can you convince those people that you can give them a return? Okay, maybe not in 1 year, maybe not in 6 months, but maybe in 2, 3, 5 years. And maybe it's not an equity proposition. It's some sort of revenue sharing or profit discussion, such that you get over that initial phase of investing. Right? I also encourage people to, if you're working, let's say you're working at a bank or whatever, you can do this on your weekends, right? You can build, you can do all this initial validation while you're working at a formal job, so that you validate your product, right? Because it may not work on the first attempt. You might have to go through 2, 3 different ideas, and there's no point raising money from friends and family because you're going to have a very difficult discussion when you go to your next wedding, right? About why did you take our money and disappear with it? So do it with your own. uh, um, do it with your own money, and that's probably going to be force you to really think hard. Like, is the time I'm spending, is what I'm building really big enough for it to be worth it? So I encourage those methods first before before going to VC, etc. There's also the accelerator route. Like there's accelerators that will take some equity and give you support. I think those are also good, but again, I would urge you to do this initial phase first before you go to the accelerator, because what the accelerator will help you with is introductions, opening doors, connecting you to the right people. Again, those are to accelerate your validation, right? But the initial building, MVP, talking to a lot of customers, you can do that without money. You don't need a lot of money for all of that. So those are some of the strategies that I urge people to really employ initially.
Yeah. Okay. Interesting. I think.
Sorry.
Okay,
one
please.
last thing is, and this is what we've done, right? Like, get customers to pay. I mean, if your customers are willing to pay, then that's money that's validating your idea and funding your growth. Your initial growth. So I think that's a very, very important concept that everyone has to. We're not. Our markets are not meant for. We'll invest 10 million, 100 million to acquire customers. It's a fancy concept that won't work in our markets, right? Your customers have to be willing to pay. If they are willing to pay, then you have a business and you have a product, and then it's wide open from there.
Yeah, so growing your business to the level you are, 25 markets, as you mentioned, I'm sure in between you must build up partnerships, strategic partnerships to help you expand and do some of the things, access some resources and all that. Partnership now is being discussed as one of the options. You mentioned customers can pay, but you may also leverage on partnerships. How have you approached partnerships at your farm level? And what sort of partnerships have you built? And what can you advise startup founders today to go, which way to go when they want to seek partnerships?
So, like let me talk about, I guess, what we've done. Primarily from our side, we work a lot with telecom providers, right? And so our partnerships primarily have been with telecom companies from Tanzania, but also beyond Tanzania, and also at group level, right? So like if you're talking to Airtel or MTN, we work with them in individual countries, but we also work with them at a group level, and we have a partnership with them at the group level. But what we've found is that it's really hard to get a large organization to devote time and resources to you as a small company, right? It's very hard. And you will want to move at a faster pace than they are ready or they are willing. And so we've tried to keep our partnerships very much as much as possible at arm's length, saying, okay, we have business for you, or we're creating business for you, something like that, right? And then negotiate harder and get more favorable terms. And we use the partnerships to get more favorable terms, maybe in terms of payment terms, like if they were initially saying 30 days, can we get 180 days? And those small things add up because it's cash flow, and it accelerates your growth in the long run. So that's been our experience with partnerships, because primarily we've been working with telcos, and as a lot of you might know, they're not the easiest people to work with or partner with. Right?
Finally, because we have had only 15 minutes, so when it comes to partnerships, the other reason why I asked you that, you talk to some founders and advise them to seek partnerships with corporates, who be buying telcos. And then there's this notion that they ask me to send a proposal, they'll steal my idea. How would you go about that? Is it a fallacy? True?
No, I think it can be true. I've seen and heard many cases of this. There's a recent case in Kenya. I think there was a discussion around how the startup was completely sidelined after they got to an advanced stage. So I think it's something you have to be mindful of. And so I always urge startups to you have to be able to stand on your own feet, right? If you can do without them, do it without them first, right? Because they will lock you in to a certain extent, or will try lock you in, and that may limit your growth, right? So you really have to read the fine print, maybe do a proof of concept, do all of these small things to kind of validate their appetite and their how willing are they to work with you, how flexible are they with you, what kind of terms are they giving you. Is it just one person? Sometimes it's the person on the other side. What if they leave? If that person leave and the next person comes into that position and they don't see it as a priority, is that going to change things for you? So all of those things can be a factor. That being said, it can really drive acceleration, right? Because let's use the telco example. If that telco is in let's say in Tanzania, and they're in Zambia as well, it's very easy for them to make an introduction for you and you to get a meeting there, right? And once you've validated and shown some success here, they want to replicate it, right? Because they want something new. So there's definitely advantages to that, but really structure it, think about it, and get some advisors who've done this before to help you look at your, if there's blind spots that you've not missed out on. Right?
Okay, Tajuad, thank you very much for your time and your insights. Can you put your hands together for Taha? Of course. Thank you very much. So Taha, I think will be around here for a while. So if you need any advice, partnerships, then you could probably reach out. So allow me to call my next panelist on stage, Anthony Adolf. Put your hands together. Managing Director, Course Prosperity Fund. Did I say it correctly? Core Prosperity. So again, you're an investor. You run a fund. We start with the same standard of introduction. What is your fund? What does it do? What's your thesis? Where do you invest? How big is your fund? And the sectors which you invest in, ticket size, and all that, please.
Hi, my name is Anthony Adolf. Please call me Tony. Good morning. So I'm the managing partner of the Co-Prosperity Fund. We are a new fund. We just were established in 2024. We made our first 3 investments in September, and we're eager to make more investments. So what we do is we provide pre-seed and seed funding, so early stage funding for micro and small businesses. We're not looking for the next unicorn. We're looking for 3 to 5 times growth in 3 to 5 years. That's our paradigm. Okay. So I hope if anybody is looking for that kind of funding, you can either talk to me or my partner, Linda. Yeah, please feel free to talk to us.
Interesting. Sector focus?
Sector agnostic.
Sector agnostic.
Which means we don't focus on a specific sector, we focus on business size.
Okay. And where is your fund domiciled?
We're based in Zanzibar,
Okay.
but we operate in Tanzania and the East African community.
Interesting. So you're a Tanzanian fund.
Yes.
Nice.
So
Yeah, should cheer for that. This is exactly what we are saying here. You're here, you set up a fund here, and you invest here.
I would call it, I'm calling it repatriated capital. I'm originally from Canada, and then my sister moved here 15 years ago, and then I decided this is a good place to live, and then I decided to start the fund after that. So I'm repatriated capital.
Good stuff. So one of the things that I mentioned in my slides was the capital flow to Africa and Tanzania in particular. And you have seen how much goes to Kenya and other 4 markets. Egypt, South Africa, Nigeria, Kenya have been receiving 85% of VC money, at least for the past 5 years consequently. What do you think Tanzania needs to do to position itself as a destination for this capital?
I think on the regulatory level, there needs to be a change in the way third-party capital is regulated. So other countries, it's very easy for an angel investing fund like ours to attract capital from Europe, North America to invest locally in Tanzania and East African community, but it's very difficult here in Tanzania to do that. We found a way to do it through Zanzibar, but it's very difficult to do that in Tanzania. So I think addressing the regulatory issues around third-party capital is fundamental to attracting capital to Tanzania.
Okay. Do you have any specific examples in our regulatory? Do you have any specific examples in our regulatory landscape? What things do you think they need to change, or is just the overall regulatory framework? Okay.
For example, I know Mauritius and Rwanda are doing a very good job of
Yeah.
becoming hubs of third-party capital.
Yeah.
And if Tanzania were to model themselves on those countries,
Yeah.
it would be beneficial to the ecosystem.
Actually, in Rwanda, I think if you are an angel investor and invest up to $100,000, there's no capital gain tax if you exit.
Wow. That would be great.
So those are things probably we might look at. So how do you source these investments?
How do I source these investments?
Yeah, these companies, startups, where do you get them for you to invest in?
Well, I'll tell you one project that we're working
Okay.
on now. Okay, we do social media advertising, web advertising partnerships, and in January we're launching Zanzibar's first business plan competition. So the ecosystem in mainland Tanzania is much more developed than Zanzibar. So we're looking to energize the ecosystem in Zanzibar by having a Zanzibar business plan competition where the top 3 applicants get funding. So that's one way we're doing it.
So if there's a startup founder here who wants to approach you to raise money, apart from the competition, how else will they find you or your fund?
A lot of angel investors, especially in Africa, are very informal. You should know that. It's more of a get to know you process, and it can take months or years just to get investments.
Yeah.
We have a very structured process. So it starts with an application on our website, then it goes to a business plan review, then it goes to a personal interview. So we have a very structured process, and it reduces the time needed for funding.
Okay.
So that's how we do it.
Okay. So I know there are people representing hubs, accelerators, and incubators. If you have an event, you have a pitch session, they should reach out to Core Prosperity as one of the potential attendants to see if they could also pick a deal or two. So how would you want to? Yeah, please.
I would also like to take note of an organization called the African Business Angels Network, ABAN.
Yeah.
They're very active in generating awareness for angel investing. And if startups are looking for seed funding from angel investors, you can work with ABAN and their members to get funding for your organizations. We're a member, and we're working on, we're starting to have discussions to do an East African working group to increase the awareness of angel investing in East Africa. And so I recommend ABAN for startups that are looking for angel investing funds.
Okay. So does partnership play any role in your fund? Let's say we have the likes of DFIs, governmental funds, as I mentioned earlier. Where do you see the importance of partnership with these other players who are also trying to invest in some businesses? And if you have any currently?
Like I said, we're still a new fund,
Yeah.
so we're still in the beginning phases. We just hired Linda to manage our partnerships, so we're starting to do that. I think government has a role Okay, so what I can say is on the supply side of capital, there's sophisticated investors, venture capitalists, angel investors, even friends and family who know how to see a return on their investment. On the demand side of capital, there's very low level of awareness and education. So we get a lot of applications that say, do you provide grants? Do you provide loans? No, we do equity-based investments. How do you bridge the gap between the supply side of capital and the demand side of capital? That's where I see partners coming into play, especially government, private sector. They can really help bridge the gap there.
Okay. So coming back to fund, just for the interest of the audience as well. So how would you structure your transactions in terms of, you do equity?
Yeah.
So what sort of stake would you take in a company when you're investing? Do you have a threshold? You can do up to a certain level, or you can do majority. What sort of stake ownership would you take in a company?
We take a minority stake between